Welcome to the Stockscores Market Minutes for January 19th, 2015. Buy stocks that are going up. It sounds simple, it sounds obvious, but many investors try to buy bargains seeking out stocks that are going down. And in doing so, they are fighting the trend of the market and really trying to catch a falling knife. It is easier to succeed by buying stocks that are going up, for buying attracts more buying. Now you can still buy weakness, but it has to be in the context of longer-term strength. We want to buy pullbacks in upward trends, whether we are day trading and looking at a very short-term 2 or 3 day chart, or if we are a long-term investor looking at a 3-year chart. If you're going to buy weakness, buy it within the context of that longer-term upward trend. And additionally, as the trade works, as the stock is continuing higher, add to your position. Never average down on a loser. All right, here's an example of a stock that I day traded today. It's one that was actually moving to new highs, whereas most stocks, because of the weakness over the past week, were going up into pessimism. They were fighting downward trends. This one caught my eye because not only was it moving up this morning, but it was also moving up in the context of a longer-term upward trend, and therefore I watched the intraday chart for pullbacks to give me entry points. You can see there the 2 green arrows. That's when I started building my position for this day trade, buying weakness inside strength, buying weakness in upward trends. And it was rewarding because by the end of the day, the stock continued higher. Buying attracts more buying. All right, let's get into this week's analysis. Here is the weekly chart of the S&P 500 going back 3 years. We review this chart every week, and it continues to be in that long-term upward trend, but the volatility is increasing, which implies that there is more uncertainty among investors in the market right now. Now, in the last 3 weeks, we have been moving lower and testing some short-term support just below 200 on the SPY. My sense is that we are still in that long-term upward trend, but there is some worry coming into the market that we need to be wary of. Now, fortunately, the market bounced off of some very short-term support on Friday, and so we don't have that signal that we're going to come down and test that longer-term green upward trend line, but I do think we need to be cautious in the short term. The Russell 2000, which is the small cap index, is actually looking better in some ways, or at least has more potential than the S&P 500. It has not participated in that trend over the past year. It has instead been going sideways, and I think we could see some rotation out of the large caps and into the small caps. So we want to watch for a break through resistance, the red line on this chart. That would indicate that people are looking to take some risk, take some money out of those large cap stocks, lock in profits, and move into the smaller caps, which have underperformed. The TSX continues to show falling tops and therefore is somewhat pessimistic. However, it is stabilizing. You can see that the volatility is diminishing. How do we know that? Well, the line that I've drawn here across the bottoms is converging toward the line that I've drawn across the top. So although it is a somewhat pessimistic descending triangle pattern that is building, at least we are getting some stability in the Canadian stock market. And we could see a reversal of the weakness if we get a break of that red downward trend line. TSX Venture is trying to stabilize as well, but it's really in an ugly longer-term downward trend. And until we can start to build some rising bottoms on the TSX Venture, generally speaking, you want to avoid this market. Now, there's always the potential for a stock to move on its own hot story, and so you can have pockets of strength, but in general, you don't want to be buying too many of these stocks right now. The TLT, which is the U.S. bond market, has gone parabolic and has broken through some resistance. Now, because it's parabolic, it means it's ripe for a pullback, but there is still no sign of a pullback, and therefore it looks to me like bond prices will continue to go higher, which means interest rates going lower. Just have to realize it's very risky and very likely that we will see a pullback in the near term. US dollar, because of that rush to safety, because money is flowing into the US market, into the bond market, and in some cases into the stock market, the US dollar has been very strong. It's at the top of its upward sloping channel. Again, that means it's overbought. That means it is ripe for a pullback, but there is no sign of weakness in the US dollar yet. Now, gold had a good week, and this is interesting because with the strength in the US dollar, you would expect the opposite. You would expect that the gold market would move lower. But it demonstrates that money is looking for safety. When the Swiss decided to decouple their currency from the euro, we saw that rush into gold as a sort of a safe haven, and that has put gold at its downward trend line. It's right at that downward trend line. If it can break through that next week, we may see more strength in gold. At this point, I consider the strength to be a trader's rally, one suitable for day and maybe swing traders, but I'm not yet convinced that you should be buying gold and gold stocks for the longer term, because the longer term chart is still pretty pessimistic. Speaking of pessimism, here's the oil market. It is ugly, but an encouraging sign this week as it managed to come back from weakness and close above its open for the week. That signals something I call a dead cat bounce, which implies that we could see a little bit of a short covering rally, a little bit of a bounce back, some bargain hunting in the oil market, and that might make oil stocks suitable for day and swing trading over the next week or two. I don't want you to start buying these for long-term holds just yet because it is still very early in a reversal process. But if you are an active trader, if you have the time to watch the market very closely, then certainly consider the oil stocks in the week ahead. The fear index hit new highs, or hit new local highs anyway, but closed below its open on Friday, and that implies we'll see a little bit of a pullback in fear next week. That could probably help the stock market gain some stability, but the fact that the VIX is rising in general shows that there is that increasing uncertainty. It shows that investors are looking for more risk. They don't have the backing of the U.S. Federal Reserve as much anymore, and the expectation is that interest rates will start to go up sometime in 2015, and that is why we're seeing that pickup in volatility. All right, so bullish long-term still on U.S. stocks, but neutral short-term, I do see some reason for caution. Canadian stocks bearish long-term, but they are trying to stabilize, so I put a neutral rating in the short term. Gold is still in a bearish long-term trend, but we've had some buying action in the last few weeks, and that's why I've got a bullish short-term rating. If you're a short-term trader, that's a place to trade, but realize that we are coming to some resistance on the gold chart. Bearish long-term on oil, but I've raised my rating to neutral short-term simply because we had that dead cat bounce, which could help the market reverse in the short term for oil. U.S. stocks suffered this week, but they've held that support level. The long-term trend is bullish, but fighting some short-term pessimism. Canadian stocks are slowly stabilizing. Gold has had a good counter-trend rally. Next week will determine if it is more than a short-term rally. Oil may make a dead cat bounce next week, but you still want to be pretty cautious overall in the oil market. All right, that has been the Stockscores Market Minutes for January 19th, 2015. Have a great week in the market and trade well.